We now come to the third and by far the most preferred method of calculating the cost of equity, the capital asset pricing model, or CAPM. CAPM says that the returns to equity are made up of two components. You have an expected return component, and then you have shocks that affect expected return. Note that we're looking at returns to equity, so we're really taking the viewpoint of the investor in the equity. But since the investor in the equity receives the same cash flow as the cost of equity from the company's point of view, the approach is valid. The returns to equity are composed of two components. One is an expected component, and the other is a random component. There are random return shocks that mean that the expected return to equity is not realized. The random shocks form the risk of equity, and they can be decomposed into two parts. One is an economy-wide or systematic risk, which affects all companies in the market, and that is abbreviated M. And the second is a specific effect. Note that we subscript it I, so this is for the ith company in the economy, and the ith company is affected by specific risks or unsystematic risks. The usual equation that we associate with CAPM is that the returns to equity of the ith company are equal to the returns of the risk-free rate plus beta times the excess returns of the market plus a random term which corresponds to the unsystematic risk of the company. Once you have estimated what beta is, then you calculate the cost of equity simply by adding the risk-free return to beta times the market premium. So you can see that the only risk that counts in calculating the cost of equity is the risk associated with co-movements with the market. As you can see, this is a linear relationship, and so we can estimate the parameter of the equation, the beta, through linear regression. Two factors have led to the popularity of CAPM. The first is that it's theoretically very concise, and the second is the ease of estimating the beta risk parameters through linear regression. To show you the ease of calculation, I've calculated the beta for Sinopec. First of all, we need a series of closing prices. This is the closing prices of Sinopec from the 3rd of November 2014 through to the 30th of October 2015. For each of the closing prices, we calculate a return. The return is the logarithm of the price relative. So that gives us a daily return. So in this case, on the 5th of November 2014, calculating from the closing previous day's price, Sinopec returned negative 1.5%. Calculation of beta requires us to regress the returns of the stock against the returns of the market. So we need a proxy for what the returns of the market are. In the United States, typically one uses the S&P 500 index. In Hong Kong, a useful proxy for the market is the tracker fund. This is stock number 2800. It's an exchange-traded fund that was set up in November 1999 to provide a vehicle for investors to access a broad portfolio of Hong Kong's most liquid stocks. And the component stocks of 2800 are weighted by their market values. So it's a good proxy to use for calculating betas. And once again here, we're calculating the daily returns. You can do a regression by doing the data analysis, clicking on regression. The dependent variable is the return of Sinopec, and we're explaining the return of Sinopec by the independent variable, which is the tracker return. A simple click and we have the regression results. As you can see, we've explained about 50% of the variance of the stock returns with the market returns. The coefficient of the market returns, which is the beta, is 1.01, and it's highly significant with a t-stat of just over 15. The 1.01 means that when the tracker fund goes up by 1%, Sinopec is also likely to go up by 1%. So as you can see with Excel, beta is very easy to calculate. The regression of Sinopec's stock returns against the tracker fund yielded a beta of 1.01. We only need one more variable to put into our equation, and we can calculate the cost of equity for Sinopec according to CAPM. The risk-free rate, as I said, will be using the 10-year government bond in the appropriate currency, renminbi, and the question is now the equity market premium. This is the expectation of the average return of the market over the risk-free rate. This expectation, unfortunately, is not observable, so we can use past observations of the realized equity market premium in order to estimate the true equity market premium. Ross, in his textbook, suggests that we use 7% for the equity market premium, so that's what we'll do. So the cost of equity, which is the risk-free rate, plus beta times the equity market premium, is 3.62% plus 1.01 times 7, 10.69%. CAPM lies at the heart of what is academic finance. The Nobel Prize in Economics in 1990 was given to Harry Markowitz, Merton Miller, and William Sharpe. 2 out of 3 of those scholars, Markowitz and Sharpe, are behind CAPM. Sharpe's paper in 1964 outlined the capital asset pricing theory, but Sharpe was working based on Harry Markowitz's PhD thesis that was published in the Journal of Finance in 1952. And what Harry Markowitz did is used computers for the first time in finance. He described stocks and portfolios of stocks of having 2 characteristics: expected return and risk. He defined risk as the standard deviation of returns and observed that the higher the expected return and the less the risk, the more efficient was the portfolio. So moving in this direction was the direction of efficiency. He showed that diversification was extremely important to moving in that direction, because even if you just had 2 stocks, as long as those 2 stocks were not perfectly correlated, combining those 2 stocks would give a reduction in risk while not sacrificing expected return, giving this typical balloon shape to the efficient frontier. I calculated the efficient frontier with 2 shares with these expected returns and standard deviations and this non-perfect correlation. So I said that share 1 and share 2 had a correlation coefficient of 23%. I then calculated 11 portfolios ranging from consisting only of share 2, 10% share 1, 20% share 1, 30, 40, 50, 60, 70, 80, 90, down to 100% share 1. So here is the portfolio made up of entirely share 1, and this is the portfolio made up of entirely share 2, and these are the intermediate portfolios. Sharpe built on Markowitz's work on diversification of portfolios of securities by introducing borrowing and lending at the risk-free rate to create leveraged, efficient portfolio. By borrowing and lending, the portfolios would always do better except for one point, where the risk-free borrowing and lending line is tangential to the efficient frontier. So the efficient frontier can be made more beneficial to the portfolio holders by borrowing and lending. His idea of the security market line was that the reward-risk ratio of all stocks in the market must be the same. The reward-risk ratio of the expected return minus the risk-free return of stock A divided by the risk of stock A had to equal the expected return minus the risk-free rate of stock B divided by the risk of stock B, which also equaled the expected return of the market portfolio minus the risk-free rate divided by the beta of the market portfolio. And of course, the beta of the market portfolio is 1. And you can see that our security line formula is just the same as the CAPM formula by multiplying, bringing beta to this side of the equation, and by adding RF to both sides of the equation, we end up with the expected returns to the 8th asset are simply equal to the risk-free rate plus beta times the equity market premium. So looking at our security market line, we have our expected return on the y-axis and our risk on the x-axis. And remember that according to CAPM, the only risk that is priced is systematic risk, and that systematic risk is parameterized by beta. We have a beta of 1.01 for Sinopec, and that corresponds, given a risk-free rate of 3.62, with an expected return for Sinopec of 10.69. Clearly, if there was a stock that had a beta of, say, 0.5, then that stock would have to have an expected return of 7.12%. And if it didn't, if it had an expected return above that, then nobody would buy Sinopec because the other stock would offer a more attractive risk-return relationship. Because nobody would buy Sinopec, the price of Sinopec would drop, raising its return, or the price of the favored stock would rise, dropping its return until such time as all stocks lay on the same security market line, where the intercept of the security market line is the risk-free rate, and the slope of the security market line is the market risk premium, which in our case is 7%. It is, I'm sure you'll agree, a beautiful theory, but there's many problems with CAPM. From a technical point of view, we used ordinary least squares to conduct our regression, but in practice there are many econometric issues, and different analysts use many more complex methods than the one we have introduced to calculate the betas. We used a one-year horizon with daily returns, but there's no particular reason why we should do this, except in our case, convenience. In practice, different horizons will lead to different betas. We can think of using a 5-year horizon with monthly returns. We could think of using a 2-year horizon with weekly returns. They all have their advantages, but they lead to different conclusions. You will remember from our discussion of foreign exchange and the parities that there's a difference between arbitrage and speculation. The relationship holding CAPM in place are speculative relationships, and these speculative relationships, because the market is often inefficient, because there are insufficient speculators, because the market is often illiquid, speculative relationships cannot be expected to hold things in very tight bonds. There may be incomplete and unstable consensus among investors as to the expected returns, risks, and correlation structures. And finally, market expectations and firm structures change over time, and this changing will mean that the betas are subject to change without notice. And there's a glaring problem with respect to the equity market premium, RM minus RF, the slope of the security market line. According to a series of studies by Professor Fernandez of the IESE Business School in Madrid, the lack of consensus, even among professors, is huge. U.S. professors, on average, think that the slope of the security market line is 6.3%. European professors think on average it's 5.3%, but the ranges in different countries go from 4.1% for Belgium to 10.5% in India. Moreover, the dispersion within each country and even within the same institution is high. The average dispersion of the professors in the same institution, so the same university, is 3.5%. Clearly, there isn't much consensus here. CAPM is theoretically sound if equity returns are normal and if investors are rational and if information is shared. In practical applications, its use is highly dependent on the beta and on the equity market risk premium. It is used in industry because it can be objectively applied, but it's empirically only weakly substantiated. Let's summarize our weighted average cost of capital calculations for Sinopec. Our cost of debt is 5%. Actually, that cost of debt is 4.95%, but here I show it rounded to one significant figure after the decimal point. We want to calculate the cost of debt on an after-tax basis because the cost of equity is on an after-tax basis. I calculate the tax rate on an average basis. I do that by summing the taxes for the 3 years for which we have data and divide that by the sum of the earnings before tax. My after-tax cost of debt is simply the cost of debt times 1 minus the tax rate. The cost of equity I take from the capital asset pricing model, where I use our regression coefficient for beta and add to that the equity market premium of 7%. We wish to use market weights for debt and equity to calculate the weighted average cost of capital. Here is the equity market capitalization, which is the number of shares outstanding, times the ending period price per share divided by 1,000,000 to get us into millions of renminbi. I get the debt value from the managerial balance sheet, adding the short-term debt to the long-term debt, and that gives me a total market value of assets. Note that I assume that debt book value is equal to debt market value, and typically debt book value is close to the market value of debt. Our weights of debt and weights of equity are simply equity divided by market value of assets and debt divided by market value of assets, and that gives us our weighted average cost of capital. Note that the largest single factor that could change that weighted average cost of capital is the cost of equity. I have a cost of equity of 10.7 from the CAPM, but by altering the equity market premium in CAPM or by turning to the dividend discount model, I could easily reduce that to 8.6%, and that would give me a much lower weighted average cost of capital. That brings to a close my discussion of cost of capital. Companies need cost of capital for financial analysis. The cost of equity is critical to the cost of capital, and in calculating the cost of equity, one should cross-check between the dividend discount model and the CAPM model and confirm that the costs are sensible relative to the risk-free rate and the cost of debt. While the theoretical attractiveness and market acceptance of CAPM is very high, the fact is that the key parameters are unobservable and unstable, and this fact argues for humility on behalf of the analyst.